So Daniel, thank you so much for hosting me here in Brno. It's a real pleasure to be where it all happens, where you manage the Vltava fund. We are here today to discuss your new book, Hidden Investment Treasures, which I can very warmly recommend to everybody listening to this. Today, hopefully, we get a nice preview and some insights that are in the book. But you've been a best-selling author in the Czech Republic before. So my question to you, what motivated you to write this new book? How did it come about?
Okay, well, first of all, it's a pleasure to have you here in Brno, to be able to host you, and it's always a pleasure talking to you. So, I'd like to thank you for coming. And the idea to write this book came quite unexpectedly. It's an interesting story. About a year ago, I think it was May of last year, I was attending a conference in Denmark called Nordic Value, which is organized by my friend Ole Scheberg. And this conference has a format where it's only based on invitation, and it's not open to public. And every participant presents one concrete stock investment idea. So in 2 days, you get like 35 different stock ideas. And this is the kind of content or type of conference that I like most, because you can talk about various things, but the bottom line in stock picking, in active investing, is which stock you decide to buy. So individual ideas are, I find, the most valuable. So I was listening to those presentations there, and then it occurred to me that it would be interesting if someone actually wrote a book that would consist only of those investment ideas, because it would be able to show to readers that you can be active investor, you can find a lot of investment ideas, and you can have fun, while doing that. So I started remembering whether I can recall a book like that I read, and I think I read almost everything that was written about investments and relevant topics over the last 30 years, and I couldn't remember such books. So I immediately jumped to another idea. Why don't I write a book like that? So why don't I write for myself something that I look for from the others most? And I get very enthusiastic about things quite often. So while on that day in the morning, if you ask me if I was going to write another book, I would say probably no. In the evening, I already had sketched the list of chapters, and I was really looking forward to come back home 2 days later and start writing. So it was I didn't expect it, but I enjoyed writing the book a lot afterwards.
Yeah, it's really quite a unique book, and maybe the reason why there are all these investment books out there, but not one like yours, is that a lot of folks don't like to put their ideas out there, especially in real time, because people like to emphasize their winners and kind of put the losers somewhere on the back burner. But you really put yourself out there, because as I understand it, and from reading the book, the case studies really are in real time rather than accounts of past
winners. Yes, the book consists of about 15 individual investment ideas, and when I was selecting them, the main condition was that I would only write about stocks that we actually own, right? So you could pick, it would be easy to look at the market, look at the last 5 years, and pick, retrospectively stocks that did well over the last 5 years, and recreate, ex post a story why then and there it was a good investment, but that doesn't really help much, So I only talk about stocks that we actually own. And you're right, it's not very popular among investment managers, because you're revealing what you do, and B, you're putting your neck on the line, because inevitably some of those ideas will turn out not to be that great. But I think it would have more credibility. And I also try to pick stocks from various industries to show that you can really look for value in various places today in the market. And I also wanted to try to select stocks where you can demonstrate on them some more general investment topic that could be applied to other companies in more general way, or over time, that things are valid over time. So that was my selection process.
Yeah, and I think what's great is you really do cover a very wide range of investment scenarios, sectors, through the case studies you've picked. And I'm wondering whether you picked the case studies in order to illustrate such breadth, or is that a result of how you manage your portfolio and how you kind of construct it for diversification?
It's both. I definitely there are more stocks that we own that I talk about in the book, but in some cases you would be repeating yourself because they come from the similar industries or have a similar investment ratio. But I wanted to show the breadth of the opportunities that are available in the market like that. And also, most important, I think, is that in theory you can write a book about investment ideas at any time, okay? But I think the book is also quite timely because we are living in times where equity markets are dominated by passive investments, and that creates a lot of opportunities for active investors. And I wanted to show them, and also maybe to suggest how you should approach stock selection process in order to turn the situation that most of the money is being invested passively to your advantage.
Yeah, that's a great point. And we'll get into some of the case studies a bit deeper in a moment, where Asbury, you illustrate how share repurchases can create value. You have an example on value accretive M&A. You have kind of a special situation in the legal litigation space and so forth. So we'll get into the case studies. I think those are always of interest to everybody because they may yield good investment ideas. But maybe we can talk just a little bit about the opportunity for active managers like yourself in a world that is so dominated by passive investment flows, and why that creates an opportunity for stock pickers like yourself.
It's very likely, especially in the US market, which is now about more than 60% of the world capitalization, that majority of the money is being invested passively, okay? And that changes the character of the stock market in a big way. Passive investment is a good idea by itself, but passive investors rely on activities of active investors, right? Because passive investors, they buy index, or some benchmark, and they don't really care how much they pay for individual stocks within those benchmarks or within those indices. They rely on activities of active investors, and they hope the active investors, by their appraisal process, by their selection process, by their buying cheap stocks and selling expensive stocks, they create the price discovery process, and they basically over time make sure that stocks are approximately reasonably valued, or they tend to approach over time their fundamental values. But if there's a few of passive investors and a lot of active investors, that works fine. But in today's world, where most of the money is being invested passively, and there's only a fraction of people among the active investors that actually do stock valuations, the price discovery process is very distorted. First of all, the passive investors, they cease to be price takers, and they are now price makers. They actually influence prices of individual stocks, even if they don't actually analyze them individually. And that's because the flow of passive money into various indices influences composition of the indices, which in turn, tells where the money is flowing. And there are many indices, many benchmarks, many ETFs, so they influence each other. And so the passive investors have now become price creators or price makers. Also, the price discovery process is still working, but it's much slower because among the active investors, there's only actually a small percentage of them that actually does stock valuation, because you have a lot of algorithmic trading, you have a lot of momentum strategies, you have among the active investors most of the retail investors, which I think most of them don't really have abilities to value stocks. So people actually do fundamental valuations. They actually represent only a very small fraction of the market. And now the dynamics of the market is such that when the money is flowing into passive funds, and the passive funds have to buy stocks immediately because that's what they do when they get money inflows, by definition, the sellers have to come from the active investors, right? Because if passive are buyers, the sellers have to be active funds. And because there's so much of passive money and so little of active investors, that when money is flowing into passive funds, the prices that are required to balance the marginal demand and marginal supply of stocks tends to go exponentially higher, because in theory, if there was one last active investor in the world, the price that you have to pay to sell his stock would be, in theory, indefinite, right? So the prices tend to rise exponentially in market and also in general, and also in individual stocks. When money flows out of the passive funds, it works the other way around, because the amount of money available among the active investors to buy the stocks that the passive funds are selling is relatively small. So prices have to go down exponentially, to find the equilibrium. So the market trends are now longer and more extremes in both ways, up and down, both in the market as a whole and in individual companies. What also worries me is that the percentage of passive investors has a very negative impact on corporate governance, because now when you pretty much pick any single stock and take a look at who are the largest owners, it's almost everywhere. It's a Vanguard, BlackRock, passive funds, So the passive funds are the biggest owners in most of the individual stocks. And I think they don't really have any motivation or tendency to really care much about what's happening in those individual stocks, because they don't really care how much they cost. Their business is not to manage money. Their business is to collect money and just, shift it to those benchmarks. So if one of the smartest and most knowledgeable investors that there is, Jim Chanos, who I think is teaching at Columbia University course on the history of financial fraud, if he's saying that we are living now in the golden age of fraud, right, and I think unfortunately we are, a big reason for that is the prevalence of passive investors, because they don't really care about what's happening in the individual companies, and the oversight over management is very weak. So this is the environment that we are living in, and I try to describe this in the book, and I also try to describe how, if you are an active investor, how we should approach the stock selection process, not only to let's say find good ideas, but also to turn the whole situation to your advantage.
Yeah, and that's the ultimate goal, right? And I know you are finding many ways to do that. We'll talk about some of the advantages that an active investor like yourself has in a world of passive money. I frankly think there's also a bigger issue around the functioning of capital markets, because the whole purpose of the stock market is to allocate capital efficiently within an economy, and with so much money passively invested, that function seems to be breaking down. Now, that may not matter so much to an active investor, but I think it should matter to regulators and society at large.
Yeah, I 100% agree with you. I mean, you cannot measure those things, so that means that they go unnoticed and no one is able to figure out, how much damage it creates. But if you are living in a world where stock markets are not efficient enough, and the incentives, the price incentives, that would attract capital are distorted, the capital flows to different places, not where it brings the biggest return, but just where the market seems to be, shifting it, and I think it lowers the efficiency of all capital allocation process, and that costs society as a whole a lot of money, although no one can figure out how much can that be.
Yeah, I think even John Bogle, the founder of Vanguard, said that at some point, if passive becomes too large, it's actually detrimental.
He said the things will collapse. Of course, you will never get to a situation where all the money would be invested passively. I mean, things would get bad much, much earlier. But I think we're already very far down that line. And I don't think, the thing is that the ability to buy an index, so the passive investments, the ETFs, where John Bogle was, big creator of all of that, is a great idea. But like almost every great idea, if it's carried to an extreme, ceases to be really a good idea, So I think this is where we are at the moment.
Yeah, to me, I kind of compare passive investing to derivatives on securities, where derivatives take the price of the underlying and passive investors take the price that's in the market. But if derivatives were to become the driving force, it would clearly lead to distortions. And I think with passive money, it's similar.
The whole passive investment, I wouldn't say mania, but growth is also creating certain systemic risk for those index investors, because if you, more in the US than in other markets are less so concentrated, but in the US, the fact that a handful of top companies are now create the largest percentage of the index in history, if you look at market capitalization, but not if you look at earnings. And many of them are, related to each other by either being in a similar business or actually, by creating business for each other, like, for NVIDIA, etc. So there's a certain systemic risk. And of course, it feels great if it goes up, right? But if it turns around and money starts flowing out of the market for some reason, who's going to be the buyer, I don't see anyone,
So let's talk about how you take advantage of this.
Okay.
Because everybody knows that if you have someone at the poker table who doesn't know how to play the game, you are at an advantage. But I feel like in the stock market, some people are falling for what I view as a fallacy, that because there's so much passive money, now all of a sudden active investors might be at a disadvantage because the passive money is moving things around. But to me, the more quote-unquote dumb money there is in the market, the better, right?
No, I think the environment for active investments now is extremely favorable. I've been doing this for more than 30 years, and I don't recall less competition among active investors than today. 20, 30 years ago, it was much tougher to find good investment ideas. Now it's actually much easier. But I think you should approach it with certain qualifications. Like, for example, we've noticed, maybe now it's 2025, so let's say 7 years ago, we noticed that at that time already passive investments was growing very fast. And what we noticed is that there were a lot of companies in the market which businesses were doing very well. Okay, they were growing earnings, they did very well. They had no troubles in their business, and they showed good business performance. But the stock prices didn't go anywhere, for a year, 2, 3 years. Like the market paid zero attention to them. And So we were wondering why is that, and I think the main reason is that most of these companies are away from the main indices, from the large caps, etc. So the passive money was completely, it was not touching them at all. Maybe even worse, was actually creating outflows, because the concentration game was already in play. So we wondered, how we could use this to our advantage, and I think the answer was pretty obvious. Is that if you didn't want to get in a situation when you would buy good performing stocks, but you would also know that nobody would pay attention for a very long time, because then it's kind of dead money, and also in theory, at some later point in time, the price may catch up with value. It may be very, very frustrating time to wait. So because market wouldn't pay any attention to it. So we said, okay, well, what if we find stocks that are good businesses, are cheap, market doesn't pay any attention to them, but they create the demand for the stock themselves by buying a lot of their own stocks, right? In that case, you don't really need the market to notice how good the businesses are and how cheap and come up with a buying demand. You actually don't actually want it. You want these companies to stay as cheap, as unnoticed as long as possible. If they can buy 5, 6, 7% of their own stock at 6 times earnings year after year after year, the final outcome would be very, very favorable, probably exponential. So we completely reanalyzed during 2019. We completely reanalyzed maybe 300 companies that we follow, and we paid a lot more attention in our analysis to the asset allocation of the companies themselves, especially to buybacks. And then we basically now have a portfolio where more than 90% of what we own consists of companies that consistently buy back their own shares. And I think there you take advantage of the situation that the passive investors don't pay any attention to many of those companies, but at the same time, you don't need them to start paying attention because the companies are already buying themselves. And if the management realizes that buying stocks back at 6 times earnings is probably a much better alternative than doing anything else, and they do it year after year after year, I mean, that's the way to go. And things like that weren't really available 20 years ago. There were much more competition, and the stocks didn't go unnoticed for a long time, and the managements didn't actually have that opportunity to buy their own stocks cheaply for years. So I think that's one way to go.
Yeah, so as an active investor, I mean, it seems like you're in a race with most of the competition not even trying to win.
No, and I would actually, selfishly, I would love even more passive investors, right, than today. Of course, it's not good for society, but for active investors, it's probably the best they could wish for.
Yeah, absolutely. And I think what you mention on the topic of share repurchases and companies basically creating their own demand for their stock, but maybe even more importantly, increasing intrinsic value per share as they make those buybacks at a low price. That's one way to avoid so-called value traps. So let's talk a little bit about that, where you look for opportunities, because I know you like to look at areas that are out of favor or underfollowed, neglected. How do you go about that aspect of the approach and idea generation?
Yeah, there's a saying, and it probably also is by definition correct, that only unpopular assets can be really cheap, right? Because if something is very popular, everyone loves it, everyone is optimistic, then it's probably also reflected in the price and things are expensive. So on the other hand, if something is unpopular, unfollowed, underfollowed, under-researched, under-owned, boring, stuff, then there's a good chance that something like that is cheap, okay? But it's not absolute truth, but I think it's a good point to start. So we tend to find a lot of good ideas pretty much in every industry, but mostly in places that are untouched by the flows of passive money, which means that it's not in the largest caps, not in the most popular industries, maybe in some other countries outside of US, etc. But I can't really specifically point out a country or industry or specific size, that would seem to be, very ripe with opportunities. The job opportunities are definitely almost everywhere you look at if you're looking at the right places. It's a time looking for them is a time-consuming process, of course, and that's good because most people are not ready to to do things like that. But I think opportunities are almost everywhere, and one of the purposes of the book was actually to show that you can actually find them in various industries, various countries, various sizes of companies, etc.
You've been investing for decades now. I'm wondering how your philosophy has evolved over time, and whether that evolution has also been affected by the passive investment flows getting bigger.
Yes, it was. I mean, my first portfolio was in 1993. Okay, and at that time it was only of our domestic Czech stocks because we didn't know anything else about other markets. And I was a broker at that time. So I was already long-term oriented, but I knew very little about valuations, about stock selections, and as I say, I only invested in domestic market. So it was retrospectively very naive. But as a broker, I had a lot of hedge funds and famous investors and investment funds, in the US and UK as clients. And when I was visiting them, I was listening, to them telling us or telling me what they do and how they do it, different strategies, different parts of the world, etc. So I started looking outside of Czech Republic for stocks, and I started my horizon was broadening. But things changed a lot at the end of 1998. I think every person has certain moments in his life that he will remember forever. Like, you hear the news or something happens to you, which is so impactful that you remember what you were doing and where you were at that moment, and you remember it forever. So I actually remember reading Benjamin Graham's Intelligent Investor for the first time to this day. I knew exactly when and where, because the book.
When and where?
I was living in England at that time, so I was reading most of that either in my study or in my bedroom. And it was the last 2 months of 1998. I recall it very, very clearly, because the book has such an impact on me that like no other book. I mean, of course, today, a lot of the parts are a little bit archaic, but there are some certain parts of it which are very fundamental, like the notice, the idea of a fundamental value, with the margin of safety and the Mr. Market allegory and stuff like that. So it changed my thinking completely, and I started applying Graham's teachings to my investments. So I became very statistical and number oriented after that, so I had a broader portfolio of statistically cheap stocks, and it worked quite well for a while. But after a while, I noticed a few things. One, that the opportunities were disappearing as the market was getting more expensive and you couldn't really find those deep value stocks. Although you had to deal with the small and small market caps, which is, expensive and not too appealing, etc. And I was learning more about investments, and I started gravitating more towards better businesses, And then I had a period of time when I thought that I'm already so good that I tried to do unnecessary complicated stuff, like as if I was trying to show to the outside world how smart I am. I learned from that, and I think the best investments are those that are the most simple ones. I think the simpler the better. So things are evolving all the time, and the last several years, I think the approach that I describe, in the world of dominated by passive investments, is again changed how we select stocks, and And I'm really curious, how things will continue developing, and whether in 5 or 10 years from now, I would think that this was not the best, that things could be done even better. And so it's a never-ending process. Like you never achieve a stage, I think, or state where you would say, okay, right now I'm a good investor and I can just relax and stop learning and never, because things are always. You can always get better, and you can always learn something new, and you can always adapt to how the environment is changing around you. So that's what I find most fascinating about investments, that every day you have new intellectual challenges or inputs and signals that you can work on.
You're running real-time experiments, but not in a controlled environment.
Exactly.
Because the market is always changing.
You don't have all the information. You can't control environment. You have to deal with uncertainty. With
Yeah, I mean, I think that's why so many of us who are investors love investing, and you can do it for your whole life and keep learning, which I think is very rare.
It is very rare. You'll find very few areas where you can hope to be better and better and better till very old age. In most other areas, in business, life, sports, and anything else, you reach your peak relatively early, and then you only go down. But in investing, because it's mental, as long as you can stay mentally, sharp, you can basically keep growing better and better, because every day you accumulate more and more knowledge, and you cannot jump over those stages. Things just don't happen to be happening faster because you want them. You just have to live through them day by day.
Yeah, and a lot of the fallacies in markets or the boom busts, they happen at least once a generation. So to the new folks entering the market, they may think they've discovered something, but people that have been investing for 5 or 10 years, they basically know only one stage of the market, right? State of the market. And if you've survived at least a couple of these cycles, you have more of a reference point.
Yeah, you become more skeptical, you become more careful. The younger folks may think you are also a dinosaur, like, they've been telling about Buffett for the last 40 years that he's out of touch. But, he keeps learning.
Yeah, I mean, the famous saying, this time is different, when it almost never is. But I think even a lot of experienced folks fall for that fallacy because it's so alluring when the market is doing well to believe that maybe this time really is different.
The question is what the definition of what is different. Some things change all the time, but some things never change. I think, and people should remember that.
Yeah, I mean, we have now AI. Obviously, that's the new thing, and it's definitely very powerful. And a lot of people will say, well, this time really is different because AI truly is so transformational. And it might be in a lot of ways. I do agree that it is. But when it comes to the basics of investing and how value is created for shareholders, that's still the same last time I checked.
Yeah, I agree.
So let's get into some of the case studies in the book, because I think that's really a lot of the value of the book is in those case studies, both in terms of generating potential ideas for readers to delve deeper into, but also for creating those mental models and patterns that could lead to other ideas as well. Maybe we can start with this idea of share repurchases creating value, and I think probably applies to a few of the case studies, certainly to Asbury Automotive. So maybe you can just walk us through that case study or another one if you think it's relevant.
Yes, you can. I mean, the stock share repurchase is like a recurring theme in the book. There you can find it with various stock ideas, And I specifically talk about it in more detail with the Asbury Auto story. Asbury Auto is one of the largest U.S. Auto dealers, and it's a business that has been growing amazingly fast, both by acquisitions and by stock buybacks. The business is. When I talk about growth in business, I usually refer to as growth per share, right? Because as an investor, I don't really care how big the company gets in terms of absolute size. What I care is how big it gets or how profitable it gets in terms, per one share that I own, right? So a lot of companies are growing very extensively by issuing shares, doing acquisition, etc., etc. But if you are, issuing a lot of stock-based compensation shares, etc., so the share count keeps growing. So per share growth is much slower, right? So when I talk about growth, it means per share growth. So in case of Asbury, they grow both in absolute terms through acquisitions and organic growth, but also even much faster per share because the share count has been going down over time quite rapidly, and because it fascinates me. You have a company that have grown maybe 20 times, in size over the last 20 years or so. And will probably keep growing much faster than the market, and it keeps trading at 8 times earnings. So, if the company can keep buying their own shares at 8 times earnings, that probably is extremely good value enhancing transaction. And so I generally like stock repurchases, but of course not all stock repurchases are value creating, because the management has I tend to put a lot of emphasis on the asset allocation on the side of the management, and on the side of how they can use the money. That there's number of things that they can do. They can do, of course, there's a replacement capex, there's a growth capex, there's some organic growth. You can do acquisitions, you can buy debt, you can return money to shareholders either by dividends or by buying back stocks. I'm not a big fan of dividends because dividends are first taxed, and secondly, they usually set up in a rigid way which doesn't pay enough attention to how efficient the allocation that is. But I like stock share purchases if they are done on a good value. Unfortunately, there's probably $1 trillion of stock buybacks in US per year now, so a huge amount of money. But I would say at least 3/4 of that is done at prices which are way above the intrinsic value of the stock. And if the management buys stock above its fair value, it basically transfers money from the selling shareholders to those that remain in the stock. So if you remain shareholder, it damages your fundamental value. So for me to like share repurchases, they have to be done. One of the conditions is they have to be done below the fundamental value of the stock, and in that case, the value is transferred from those that sell the shares to those that keep owning the shares. So if I keep owning a share, my fundamental value of the share keeps going up. And if the management is disciplined enough, so every time the management always, we have very limited ways of how to judge it, but the management at every time has at least those 5 or 7 basic options how to allocate capital available. We don't really know what are all the options available to them at a time, because we don't see those that they reject, for example. And even if we see those that they do, very often we cannot actually ex ante calculate the return on those investments. You can try to do it ex post, but not ex ante. But if the management is truly looking at all these options continuously and always trying to send money where there's biggest return on investment, then buying stocks at single-digit multiples often is by far the best way, because the acquisitions are usually more expensive. They also carry much more risk than investing in yourself, and trying to going for absolute growth is sometimes also not very efficient. So yeah, I love stock buybacks, and if you some of the stocks that we own, have decreased the stocks so much that it's unbelievable. I mean, we used to own AutoNation, which is a peer of Osbury, another dealer, bit larger. Their share count over last 25 years is down maybe 90%. Okay, so your ownership of the company went up 10 times, even if you didn't buy any stock, and the company itself is much bigger. So I like those things a lot.
Yeah, I think, and there's a nuance there because, as you say, if companies are buying back stock below fair value, they are accreting value on a per share basis. And with Asbury, that is the case, or was the case when you invested. It still sounds cheap.
It still is, yeah.
Some other stories become expensive because people look at the historical stock chart maybe when management was able to buy cheap and was cannibalizing its own shares. But now some of those stocks get expensive and management doesn't switch gears.
Yeah.
They keep plowing free cash flow into the stock. That seems problematic, but it's also tough for the managements because their shareholders probably want them to keep repurchasing, because almost by definition, if you're a shareholder of a company, you probably think the stock is undervalued.
Yeah.
I'm thinking of a couple of examples recently with O'Reilly Automotive and AutoZone, I believe, where these stocks are now in the 30s on a PE basis, and that's the math just works differently if you keep buying back.
Yeah, these two companies are one of those notorious stock cannibals. The share count. The only thing they do is they buy back shares. Which is okay, but if you buy at high 20s, multiple, it's not the best use of money, I think, right? So the management has to be more flexible in the asset allocation. So, but for example, we have another stock you might want to talk about later in our portfolio, and it's also mentioned in the book, OSB Group, which is a small UK bank, and they also do very, very large buybacks regularly. But the management seem to have some kind of a metrics where it compares the price on a daily basis to its notion of intrinsic value, and you can see that if the stock is lower, they buy 300,000 shares a day. When the stock moves higher, they buy 30,000 shares a day. So they're very, very price conscious, and I think that's very important. Another bank that we own is JP Morgan, and Jamie Dimon also says, over time, because they have so much excess capital and they make so much money, they will do a lot of buybacks. But now at 2.4 times price to book and maybe 2.7 times price to tangible book, he says it doesn't really make any sense. So they might do some, but very, very little. So I think you have to be very, very price conscious because you can easily destroy value. Another good example of good allocation is Berkshire. Buffett starting buying back shares maybe 7 or 8 years ago, and he was very active 4 or 5 years ago. They were buying back a lot of shares when the stock price was maybe 25% above book value. Now at the beginning of this year it was maybe 65%, so they didn't buy any for the last 12 months. Now it's getting cheaper again, so maybe they'll start at some point. But if you have long-term, a lot of the managements have a short-term thinking horizon, so they know they'll be out 2 years from now, 3 years from now, and they have stock options, they have bonuses, so they very often it's tied to the stock price, which I don't think is a good criteria. So they just tend to do it, whatever it takes, keep the stock price up. If you're someone like Warren Buffett, who, of course, his own horizon is now short, but his thinking is as long term as ever. He doesn't get any bonuses from the stock price. He owns a lot of stock himself, so he wants the fundamental value to keep building. He thinks in long term. He knows that sooner or later the price would get cheap enough again, and he would buy a ton of stock. But until then, he's happy to accumulate cash, and So I think it's very, very. Most of the investors today either don't care, that's the passive, or have very short-term horizon, and for them buybacks are not a big part of their long-term investment team, because they don't have any long-term investment team. They're short-term oriented, and as long as the management keeps buying shares, that keeps the stock price up in the short term, and that's fine. But if you're a very long-term investor, and if you think in 5 years and longer terms, then the asset allocation on the side of the management is absolutely essential. You can kill good company by stupid asset allocation, and you can make, let's say, average business extremely strong compounder if your asset allocation is very efficient.
Yeah, I mean, I think that's just such an important point with regard to buybacks, because buybacks are great if done at the right price, and otherwise they may not create value. And that's just within the sort of, intelligent investor community. Then there's the whole other category of buybacks that we don't even talk about, which are just made for offsetting stock-based comp, which is a total waste of money. I think we would agree. But yeah, I think this principle of looking at things on a per share basis is something investors really should take to heart more, because if your favorite growth company is putting up 20-25% on the top line, but the share count is growing 5 to 10% a year, you're really not ahead that much.
I'm glad you mentioned the stock-based compensations, because in some companies this is a huge number. It runs in not billions but tens of billions per year. And for some, I know why, but those companies tend to include it in operating cash flow, like they're making money. But I always exclude it from operating cash flow, and I put it in financing cash flow, because you're basically selling stock to finance the business, right? And very often the buybacks, it looks like they do a lot of buybacks, but when you look at the details, 2/3 of the buybacks is basically buying back stocks that they previously issued at much more favorable terms to shareholders. So basically, first the free cash flow is much smaller than they show, and then the stock buybacks are actually much smaller than they show as well, because they just offset what they issued before.
Yeah,
and for many companies, the ability to, take an Amazon. Amazon is a great business, but its stock price is always bit expensive. It's pretty high, but they have been doing stock-based compensation for many years. But so for you as an investor, it's actually good if you can pay your employees with very overpriced stock. That actually increases the fundamental value of the business. And Tesla did the same. I mean, Tesla stock is always extremely expensive, and many times they issued a lot of stock at very inflated price. Sometimes, in times where it was questionable whether the company actually could finance itself. But because the market was awarding the Tesla very high stock price, they were able to issue very expensive stock, which actually increased the fundamental value of the business. Because if you can issue a relatively small amount of shares at 5 times its fundamental value, or 10 times, or 20 times, whatever, it actually increases the value of the business. So the dynamics of these is always very fascinating to me.
Yeah, I mean, that's kind of like the reflexivity argument, where, also why it's hard to short high-flying stocks, because they could issue new shares at the inflated price, and then that kind of diminishes your short thesis. If they can raise a ton of money at an inflated price, all of a sudden, they can trade, they can have this huge cash position that wasn't part of the thesis before. So, but that's, I think, a very dicey approach, to say the least, if you're going to bet on that kind of reflexivity working out, because it can also work the other way, where if a stock starts going down, all of a sudden your stock-based comp, you have to issue more shares. It gets harder to keep employees, so it can also spiral downward very quickly.
Yeah, and especially in finance industry, if the stock price is depressed, usually the companies have a very hard time financing themselves, and so the reflexivity works in negative. There's a negative loop.
Yeah, definitely. You mentioned OSB Group. I'd be curious how you found the idea. How does a smaller bank like that even register on your screen? Because you also look at bigger banks and have found value in some very large banks. So I'm curious, what's so special about OSB Group? I know the answer, but I think it'll be...
Well, you've read the book. I talk about investing in banks in general first in that chapter, because I find it interesting, because a lot of people avoid investing in banks just per se, and some of the arguments are rational or reasonable, like it's a leverage industry, it's a regulated industry, there's a lot of competition, it's very cyclical. That's true. But sometimes the arguments are less rational, like banks are black boxes, or even you can hear sometimes in the modern world there will be no need for banks, etc. But so they avoid investing in banks. But some other people, have been very successful investors, and they have been investing in banks for life, like Warren Buffett. So there's always something in between, and I think well-chosen bank can be extremely good long-term compounder. And the reason is that if you look at the balance sheet of a bank, it almost entirely consists of financial items. Okay, there's no factories, no inventories, no big capex, stuff like that. So it's all financial items. So whenever bank makes profit, basically the whole profit increases the book value. Okay, pre-dividend and pre-buybacks. But so if bank ROE is at a relatively high level, the book value, which I think for banks is a good measure of value, is growing very fast, and because you don't have this leakage, you don't have this capex and etc. So basically, it all grows up, and also, despite of the industrial companies where the assets are depreciated and you don't really know what the market value is regarding to the accounting value, but in banks a lot of the stuff is actually mark to market, so the book value is actually more it's better. So if you find a bank that compounds capital, has ROE at high level, it can be a very, very good compounder. And I have two examples in the book. One is JP Morgan, because I think when you look at banks, I think because all of the risks that I talk about, it's probably a good idea to pick the best. Okay, it's not a good idea to go for a lower quality because it's cheaper. You should stick with the best, and I think JP Morgan is by far the best managed large bank in the world. And since Jamie Dimon, he took over Bank One in year 2000, and then later on he merged with JP Morgan. And I think the return of the stock since he became CEO in 2000 is over 12% per annum, compared to maybe 7 or 8% for S&P 500. So it beats the market by far. And even if you take the JP Morgan period from 2004, it's still better than the market, and that's because the average ROE is in double digit, and that's much higher than the average earning growth of S&P 500. So this could be a very good long-term compounder. But there's another way how to look for how to select among banks, and that is our second example. That is the OSB Group, which is a smaller UK bank, and this is if you look for a bank that has a special niche in the market, which for some reason has been abandoned by bigger players, it can also be a very good compounder. And that's the case for the OSB Group. It's a UK bank with a market cap probably 2 billion or under 2 billion of pounds, or small. But they have very simple old-fashioned business. Their main business is to lend money to buy to let small businesses. So like some portion of the UK housing market is occupied by people. They rent the apartments, and these properties are typically owned by small and medium-sized businesses. So typical owner has between 1 and 7, properties, and the bank lends them the money, and it's actually a very safe business. If you first of all, it's collateralized by the real estate, so the average loan to value is about 65%, so that's pretty safe. The average cost of risk recently has been about 25 basis points, so it's very good. It's also a well diversified business because there's the loans are relatively small. Okay, so there's thousands of them, maybe tens of thousands of them, and there was a change in regulation in UK market several years ago, which made the large banks to leave this segment because for them it became too cumbersome and too labor intensive, so they just left. So it's dominated by smaller players, and OSB Group has a 9% market share roughly. Okay, and it's their main business, so it's actually very, very simple. And they IPO'd about 11 years ago, and I think the book value, if you add back the dividends that they paid, has compounded by like 17 or 18% per annum, over 11 years, which is very, very fast growth. And I would expect them to do similar in the next 10 years. I mean, the ROE, I would expect to be at least 15%, over the long term. And when we bought the stock, or when I wrote the book, it was trading around 75 or 80% of book value, which I think is very cheap. So they have been using this price to their advantage, buying a lot of stock. On the top of that, they pay a lot of dividend. So yeah, you could do well in businesses like that, I think, as well. So I like investing in banks because I've been myself in financial business for 30 years. In asset management, brokerage. I was also on the board of ABN AMRO Bank in Prague for a short time. So I have no prejudices against banking, and I think it can be if you select your stocks well, you can compound your money very well.
So it sounds like with OSB, and maybe that's a pattern that you look for, is smaller banks that have a strong position in a particular niche segment that's maybe less competitive, where the big banks don't really want to put in the effort it takes.
Yes, I mean in UK the requirement was that the bank has to sign off the business plan of the property owner, which is kind of stupid. I mean, it's in your interest if you're a bank to learn about it, but why do you have to sign it off? So the big banks said, okay, forget it. We're going to do that. We're not going to do that in order to lend 2 or 5 or 7 million to those people. We want to lend 25 or 250 million to big businesses. So they left the business, and some smaller banks increase the market share. You have to, when you're valuing bank, you have to value bank differently than you're valuing non-financial companies, because non-financial companies we tend to value based on a free cash flow. For a bank, it's pretty much impossible to figure out what the free cash flow is, right? You also don't know what the debt is for a bank, right? Because pretty much everything on the liability side is some form of debt. So for us, but because it's all financial items, we tend to combine the book value and the ROE as the two key elements for valuation. And the higher the ROE, the more above the book value we're ready to pay. So we tend to discount banks by 10%. So if a bank has ROE of 10% over time, we think it's approximately worth 1 times book value. Okay, if it has 15%, we tend to pay above book value. We try to avoid banks that have ROE less than 10% because they can be cheap, but the correction of valuation has to happen rather fast, because if it takes longer time, then the low ROE actually has very negative effects. So we tend to pick. And for JP Morgan, they expect the return on tangible equity, which is a sibling of ROE, to be about 17% over the cycle, which is a lot. For OSB Group, I expect the ROE to be about 15% over time. So if you have a 15% ROE and you start at the 1 times book value, you're probably going to make more than 15% per annum over a long period.
And I guess your assessment of management is crucial with banks.
Yeah, absolutely. Yeah. I mean, in JP Morgan, I can't think of a better managed bank if you talk about big banks. In smaller banks, there's a lot of them, so there's no way you can learn about all of them, but at least you can assess the management of those that you look at, and I like the management here as well. It's like very old-fashioned banking business. You lend the money to business owners. You own the loan till the expiration. You're financed by retail deposits. It's pretty safe for the business.
Yeah, that's sounds very straightforward. I guess with banks, it's the net interest margin.
Net interest margin, yeah, it's the key. Fees and commissions, and then on the other hand, you have a cost of risk, bad loans, and cost of your capital, basically.
Yeah, another case study that I find interesting and fascinating at the moment as well, because it's a little bit of a still misunderstood, even though they had some big positive news, is Burford Capital, where I thought the stock was going to re-rate very quickly after Argentina kind of acknowledged that there's something there. But what was the thesis when you first invested, and how has it played out till now?
Well, it's a company that I discovered about 6 years ago. It's a UK-based company, pioneer and by far the biggest player in litigation finance. Litigation finance is a relatively young industry. It's a business where companies finance the litigations for their customers, which are typically corporations or law firms, in return for a portion of the awards. If the award is awarded. And I selected the company for the book chapter because, in general, I think that humans or human capital or human work is a big value creator at the level of companies, right? The people create value by their work, by their ideas, by their effort, in general, not always positive, but in general positive. And Burford is a capital where basically 100% value is created by human capital, because it's like a private equity fund where the portfolio doesn't consist of stakes in companies, but it consists of hundreds of legal cases. Okay, and they have relatively short maturity, on average about 3 years, and when they get the proceeds, they reinvest them in new cases. So it's like a private equity portfolio which is marked close to market because it's much shorter and it's being reinvested at a relatively high level. I think the ARR over the entire history of the company is in high 20s, maybe 27. So that's the rate at which they were able to invest and reinvest the money, which is a lot. So you deduct cost of running the business, you deduct the cost of capital, you add a little bit because of the leverage, and you come up with a theoretical expected return on equity. And I think the company is a bit misunderstood still because it's a relatively young company. It's relatively small. It's been listed in UK first, but only recently in the US. And the accounting is fine, but the cadence of earnings is extremely unpredictable. It's not like a business where every quarter you book about the same revenues and the same profit, and it goes up 5% every year. The legal cases, the results are unpredictable and the timing is unpredictable. So quarterly results are basically meaningless. Sometimes they are very good, sometimes they are poor, but it doesn't really matter. It doesn't really mean much. So you think you should take a more general philosophical approach to that business, but this is still very, very cheap. I mean, but their biggest case by far is the litigation against Argentina, where in 2011 or 2012, Argentina nationalized YPF, the oil company, and they expropriated the foreign investors without any compensation, although they actually previously wrote in the articles that in case that something like that happened, they would be compensated, and there was actually even a formula how compensation would be calculated, but they didn't. So the two clients that they represent went bankrupt, and the liquidators they approached Burford, 10 years ago, 12 years ago, if they could finance the case because the bankrupt companies had no cash. And the U.S. court has awarded $16 billion to Burford. I mean, not Burford, but to defendants, of which Burford would probably get about 35%. There's still an appeal pending, so right now the sum is over 17 billion because the interest keeps accruing, and I think sooner or later Argentina would have to settle. And if there was full amount awarded, Burford would probably get about 5 billion, maybe $6 billion, and its market cap is less than 3. That's a lot of money. So of course the market discounts that award and believes that it will be settled at much smaller amount. But I think in any case it would be very, very substantial. And besides that, Burford owns a lot of other cases. Some of them are very large. And I think even without the Argentina, the YPF case, the stock price justifies the rest of the business. So you have like solid business at a fair value plus a free option for a huge upside. So we'd like to thank, but I think it's a very good, even almost textbook case of a company where pretty much complete value of the business is created by human capital, by human work. Because the key of the business is like 70 lawyers that have to be able to assess cases, be able to express them in time, probability, in monetary terms, and decide whether they do them or not.
Yeah, I think, this is to me, it looks like a classic case of investors just framing the investment thesis wrong. The Argentina case is almost like an overhang on the stock when it should be the opposite.
Exactly, yeah.
Because as you say, the rest of the business already justifies the valuation.
I think so. And, at least, yeah.
Yeah, and fundamentally from the IRRs they've been able to get on the portfolio of their litigation, it's a good business.
Yeah. And the YPF case is actually excluded from this IRR because the IRR is only calculated from the cases that were already concluded and paid for, right? So and I think there's a lot of misconception about this business because they don't initiate the legal cases, okay? They don't take them over, okay? So basically, they when a corporation approaches them, we want you to finance our portfolio of legal cases, they look at it and maybe do that. The law firms, they do the same because they don't really have a capital to finance it themselves. So they don't actually initiate the legal cases and they don't take them over. So sometimes they're looked upon negatively, like they're the vulture fund that tries to, feast on poor delinquents, right? But no, it's not. They don't initiate them.
Do you think there are any kind of legitimate concerns or risks around Burford on the competitive front, where if the IRRs are so attractive, maybe some bigger law firms would say, we'll do the case?
Well, the competition is much smaller. There are a couple of other firms that are listed, but they are probably one order smaller. And there are some private equity funds or specialized hedge funds that compete with them as well. But they have achieved a reputation and size that at a certain level of business, they have almost no competition. Because for example, they're able to finance the whole portfolios of legal cases for a corporation. So like they had a case recently where they purchased such a portfolio from a corporation like Fortune 50 corporation and then invested $250 million, which is the size of a transaction that very, very few competitors can do. It's a similar, if you're looking at the Berkshire insurance business, okay, and I think in the history of insurance, there are maybe 7 or 10 transactions where the insurance premium was $1 billion or higher, and all of them were done by Berkshire, because no other insurance company is able to take so much risk on their books, right? And I think there was even a case a couple of years ago where Berkshire sold reinsurance to AIB, and the insurance premium was $10 billion. Right? There's no one in the world that could sell that size of transaction. And I think Burford is in their own business in a similar case where they're at certain level of the market, the size of transactions, they have very limited competition.
Yeah, definitely a fascinating case. What kind of timeline do you expect on Argentina? Is there a way to tell how the negotiations are going?
No. There's still one appeal pending, which I'm pretty sure Argentina would lose. I mean, Argentina has unfortunately, it's not a fault of the current administration, but of the previous ones. They have a history of a lot of litigations, and they have lost a lot of them, and they have paid pretty much all of them eventually. They try to fight, they try to delay, it costs them eventually more, but they have to pay them. And there was another litigation regarding some of their GDP-linked bonds in the UK, where they lost the final appeal and they have to pay about $1.5 billion, and there's no further appeal. And so that case actually now appears in the documentation of IMF that's lending money to Argentina. So at some point, Argentina has to recognize this as a liability. In the YPF case, there's still one more appeal pending, and I think the government doesn't want to recognize it until every other option is recognized. Of course, it will become more expensive for them. But I think in Argentina, countries like Argentina and Brazil have a history of imprisoning previous presidents. Okay, so you don't really want to be in a situation where the next president will put you in jail because you signed a settlement, you didn't exhaust all the cases, and, So I think the time will come, probably later this year or next year, when the appeals will be exhausted, and of course it would be smarter for Argentina to negotiate settlement much earlier in the process, because the further it goes and the more they lose, the less leverage they have. But we'll see. But it's an interesting story to watch.
So shifting gears a little bit, I know you also profile an energy company. That's a whole different sector. Yeah. But I think both from a macro standpoint as well as from the company-specific thesis, it's a very interesting one.
Yeah, the company that I'll talk about is Cenovus Energy, but there's another chapter preceding that talking about the oil industry in general, And I think there's a misconception here in the heads of many investors that believe that the demand for oil will, for some reason, go down fast. There's even some projections of some agencies that project very fast declining demand for oil. But when I travel around the world, I see completely different story. I see a lot of growth ambitions in the poorer 5 billion people around the world, where their demand for energy is right now very, very low, and they have ambitions and desires to live much better life than they do. I mean, they want to get closer to what we are used to, and if things like that, if they succeed, this is going to come together with a lot of increasing demand for all types of energy, including oil. So I see oil demand growing continuously for many years down the road. And the stock price, if you look at the supply and demand, the more likely scenario is for oil to go higher over time. Let's talk about next 10 years, then down. And and of course, oil price and gas price to a certain extent is the key element when you analyze an oil company, okay? Because they all price takers. If you try to figure out what the future cash flow is for an oil company, and if you try to build a model or even do a rough estimate, oil price is always the first line Okay, so you have to have some expectations about it. And my expectations are on the upward side, not downward side. But on the other hand, we used to invest in oil a long time ago, before 2008. When there was a period of globalization and of a rise of China, and oil was of course growing up very fast. But we then, maybe 2 years later, we left the industry because we didn't like the asset allocation of oil companies. Because at that time it was like drill baby drill. Okay, so they were trying to acquire as much assets, acquire other companies, grow production, whatever it takes, because the expectations of oil price was very, very optimistic. So you have industry where you're price taker, you have very long investment horizon, you have very large upfront costs, you work with a debt a lot, and it's a very cyclical industry. So the asset allocation process was very value distracting. But then things change over time, because over time the oil companies were being pressured to stop producing oil, by the society, by politicians, sometimes by their own shareholders. So they ventured to other industries, to other activities, and most of all, they stopped investing in oil production because it was unpopular. And so just put yourself in the shoes of CEO of a large oil company, and then your chief geologist comes to you and tells you, I've got a great discovery offshore of Brazil. Okay, it will require $9 billion to invest. We might start producing 5 years from now, and we will be producing for another 15 years, and probably 5 years from the start we'll recover the initial capital. I mean, the CEO will tell you, forget it, because in today's environment, why he would be leaning against the wind of the society pressure, and why he should take the risk. So the companies have decreased their investment in new production dramatically, and instead they're returning money to shareholders, which for them is less controversial, okay, and less risky. In short run, it may be beneficial for the shareholders. So the outcome of all of that would be that the price of oil would be higher than it could be, because you will not have sufficient investment. So that's the macro story. Now, when you think about how to express that in stock selection, there's a lot of choice. There's a lot of oil producing companies. So what we do is we cluster them into 4 groups. So one group are the national oil companies like Saudi Aramco, and we got in the Gulf and the other countries, but most of them are not publicly traded. Saudi Aramco might be the only exception, but you wouldn't invest in that, and so we put it aside. And that they produce about 1/4 of oil. Then you have the super majors like Exxon, BP, Shell, Petrobras. We don't invest in them as well, because their size is their disadvantage. They have to spend a lot of money in developing new reserve, finding new oil, and this size is just the potential growth for them is very difficult to achieve. And they also, because they're so big, they also in the front line of politicians' anger or pushbacks. Then I have, on the other spectrum, you have junior oil companies that typically some of them are not even producing. Some of them rely on 1 or 2 key source. You can make a lot of money in some of them, but it's very risky area, and you have to be really specialized. So we try to look for something in the middle. We'd like to look for companies that are very profitable. They have established production. They have low finding cost. They have low production cost. They are in predictable jurisdictions, etc., etc. So, I mean, that leaves you only very few. Some in US, some in Canada. So we picked one of the 3 large Canadian ones, Cenovus Energy, because it has Canada is not always predictable, but it's one of the more stable environments. They have all the oil in place, so their development, the finding costs are very low. Their development costs are also very low because of the type of the production they do. Production costs are low because their main cost is gas, which is cheap in that part of the world. And the asset allocation policy is very good. They basically return all the free cash flow to investors by some dividends and mostly by buying back stock. So I expect over time the share count to continue going down. And if my assumptions about the future price of oil are more or less okay, then they should be able to generate double-digit free cash flow yield, and they will return most of it to shareholders year after year. So that's why the position, and also if you own some of the natural resources like oil, with all these reserves in the ground, in their case, it's for more than 30 years of production. It kind of creates hedge against certain extreme scenarios in general, like high inflation, for example, or shortages of in commodities, etc., or even geopolitical risks. So I think it has a position like that has its own place in our portfolio.
Very interesting, because obviously it is a commodity business, so not the traditional high quality kind of business, but Cenovus in particular sounds like a predictable production story more than an exploration.
Yeah, that they also have it's not only about to be able to produce oil cheaply, but you also have to be able to transport it and refine it. So they're well connected to pipelines. They have some of their own refineries. And as long as their asset allocation priorities remain as they are, we'll be happy to own. When the modus operandi changes in the whole industry, and they start acquiring each other, or they start acquiring reserves, regardless the price, we would reconsider. But as long as they keep growing at a reasonably modest pace and return free cash to shareholders, that's ideal situation. It's ideal situation for us as a shareholders. It's not ideal for consumer, because that makes the oil price higher than it could be. But we're not going to change that.
Let's talk about Berkshire, because that's the big one and an inspiration for a lot of things, including the last chapter of your book entitled Berkshire Park, which we will touch on a little bit at the end, which has a lot of parallels to investing, and I was fortunate to see it and experience it, so thank you for that. But when did you first invest in Berkshire, and how do you view it in terms of the position it has in your portfolio, because it's kind of a special company?
I bought Berkshire first in 95 or 96, so that was years before we started the fund. And in the fund, it's been our largest position now by far for maybe 13 years. And it's kind of a benchmark stock within our portfolio, because it has probably the most predictable future results among all the stocks that we own, because it develops in very, very predictable way. And it has also the least business risks of all the stocks that we own. And that's because of the balance sheet, asset allocation, quality of asset, etc., etc. So we think that we can earn, at today's price, you could probably earn 10 or 11% per annum over long run from this stock with the minimum risk. Okay, so we can, when we look at any other company, we want a higher return, because every other company has higher business risk. So we can always buy more Berkshire, right, to a certain point. So we always use it as a benchmark. So every other stock that we own has a higher business risk, but most of them, at least when you buy them, have a higher expected return. So for us, it's kind of a good benchmark that keeps us disciplined. And I included it in the book in the first chapter, because what I find fascinating is that it's one of the best long-term stories in the world, or in the US. It's been visible to everyone for decades, but yet still, so few people understand the company that I just can't. I don't really understand it, right? Because if you are an investor, even if you're a professional investor, and if you see a story that's being so successful, you should learn a lot about it, okay? To see, you don't really have to invest in it, but you should understand why it's been so successful. And even if people don't really understand. Last Saturday, they reported their quarterly earnings, and you just can see from the journalist headlines that they don't really understand the figures, okay? So, and our mutual friend Chris Broomstone got angry on Twitter because he said that I spent 2 hours talking to journalists trying to explain to them what the results are, and then they misrepresenting the story anyway, So I find it fascinating. So a lot of investors don't understand Berkshire. A lot of people still think it's kind of investment fund, right? And so, yeah, it's a, and I think among the big mega caps, it's the only one today which I think is undervalued. So that's why we still own it. It's kind of an example of a company which is boring, in a way that the development is very steady. You don't hope or don't expect to be any excitement. Yes, every 10 years they do a big acquisition, but then it's reasonably steady and boring business. And people tend to find boring businesses unattractive, which I think is a mistake, because people tend to have a tendency to undervalue the impact of a long-term compounding, which I think this is exactly what this business is about. And I think in other businesses, every company has a certain life cycle, because they have certain product that has a boom, but eventually it is replaced or dies down. And but Berkshire's business is not some product or service. Its business is compounding capital, and that compounding can basically run forever, and can be very fast on per share basis.
So what's most misunderstood seems to be this aspect that it's not an investment fund. It's actually a collection of operating businesses.
Conglomerate, basically, yeah.
With a great capital allocator at the helm.
Cheap leverage. Built-in leverage, which is non-recourse, it's for free, and it has indefinite maturity, basically, right? The float, yeah.
How do you think about the fact that it's so big now and the rate at which it can keep compounding given the size?
Yeah, it's a disadvantage. Size is always a disadvantage in investments, I think, and it's a disadvantage. And I think they should be a lot more aggressive on buybacks, because that takes portion of that problem away. They were very active several years ago. Of course, when price got actually around March or April of this year, the stock, for the first time since I think 2002, at least in our calculations, got above its fundamental value. So I understand why they don't buy right now, but over time I think they should get more aggressive. But right now I think it's about 14-15% below its fundamental value, so maybe not cheap enough for them yet. But there's that much cash, and this problem growing over time, they should maybe be more aggressive. So that's why I think that's one reason, for example, why we have Markle in our portfolio, and also it's a chapter in the book. Because what I also find fascinating, that the Berkshire business model, is being in place for decades and is visible for decades, but almost no one has been able to replicate it. Because it's not easy. So that's why I think one of the durable advantages is the business model that's been put in place in Berkshire. And Markel is one of the very few companies that at least tries to do things in a similar way and got somewhere in a successful way. And probably over the last 25, 35 years, the stock performance might be even better. Because I remember when Tom Gaynor joined Markel around 1990, I think the stock price was 20. Now it's 2000. Okay, so it's 100 bagger, which probably might be better than Berkshire over those period. And of course, it's not the same quality. It's not they're not there yet, but they're getting in a similar direction. But Markel's biggest advantage is that it's much smaller. Market cap being maybe 25 billion, so size is definitely not a disadvantage for them. So they might have they will have easier time to grow faster. But it's very difficult to replicate Berkshire's model because it's among other things, it takes a lot of time. I mean, if you look at, there's a great book about Berkshire that Adam Mead published a couple of years ago that gives you the entire history of Berkshire's transactions. And when you look at late 1960s or early 1970s, soon after Buffett became CEO, started, turning the textile company into what it is today, you realize how long it takes, So even 10 years after he, started, it was still a very small company, it's still, so these things take a very long time, and no one has the patience to build something, to keep building something for 30 years and wait for the result. So that's why it won't get replicated very easily.
Yeah, it's really the nature of that exponential curve, which for quite a lot of years looks almost flat, and then it goes up. I mean, there's that statistic around how much value or personal wealth Buffett has created after even his 80th birthday or something, and it's a lot.
Yeah, I think he was in his 50s when he became a billionaire. I mean, 1 billion today is not a lot of money, of course, but at that time it was. And if he didn't give up, if he didn't distribute a lot of his shares already to charity, he would probably be now over 200 billion, maybe 300 billion, so 300 times. So like 99% of his wealth was created after he became 50 years old. So that's the exponential curve, yeah. So in absolute terms, the biggest numbers of Berkshire are still ahead. In per share terms or in percentage terms, no. I mean that's almost impossible. But in absolute terms, yeah.
As we sit here, where's the stock price roughly?
It's about 700,000.
And when you first invested in 95,
it was about 110,000. 110,000. No, I personally, no, yeah. It was in 45 maybe. Yeah. When we first bought in the fund, it was 110,000.
Yeah.
So for me, I mean, I don't own it personally. I only see the fund now, but for me personally, it would have been 15 times. For the fund, it's about 7 times.
Yeah. I don't think we'll have that story repeated.
No.
And as you say, there aren't even many trying to repeat it. Markel is one, and maybe a few others.
Yeah, very few. Yeah.
It's really remarkable. I wonder what will happen with Berkshire after Buffett is no longer at the helm, whether it continues as one entity or if it does sort of...
I don't expect any major changes, and I think de facto a very large part of Berkshire has been run by Greg Abel already for some time. He's been in charge of the private part for some time, and at the end of this year, he will be in charge of the whole business. He would become CEO. And I mean, the longer I watch him, the more I like him. I think he's an extremely smart guy, and I mean, Buffett is Buffett, okay? There's no one else like him. But Greg might have certain advantages that Buffett doesn't have. First of all, he was running, real businesses for some time. I mean, Buffett is the CEO of a large conglomerate, true, but he's more of a money shuffler, asset allocator, very good one. But Greg Abel was actually running businesses himself, so he might have that may be an advantage to a certain extent. And I think also he seemed to have less inertia vis-a-vis some of these private businesses. Buffett bought all of them, and some of the businesses in the private section of Berkshire are probably not performing well enough. And I think Greg Abel would be tougher on them. And I think he's been already. And he might be even more disposed to get rid of some of them. I don't have any problems with him running. Of course, we would love to be reading Buffett's writing and listening to them for many, many years down to come, but that just can't happen. So,
in the book, you also talk about a couple of mistakes, which I think is also instructive to include, and their different nature of mistake.
Yeah, I mentioned two specifically. I mentioned CVS as an example of a company that we should have never bought, and I mentioned Microsoft as an example of a company we should have never sold, so I don't really have much emotional attachments to those mistakes, but I try to analyze them in sort of an intellectual way, try to figure out, what the mistake was, why it happened, and how to make sure that it won't repeat very often. I think it's important to be learning from the mistakes.
So with CVS, quickly, what was the
CVS? It used to be extremely popular stock until about sometimes the middle of the last decade, right? And then they did a huge acquisition of Aetna, the health insurance company, which was hugely overpriced. And the stock started to go down, because they acquired a lot of debt. Of course, they had a lot of interests to pay down. They had to stop buying back shares. They had to concentrate on reducing on debt, etc., etc. And the valuation kept getting lower and lower because the market just didn't like what they did. But then they replaced the CEO, and the old one, which was responsible for Aetna, was gone, and they brought the one who was previously running Aetna as the CEO of CVS, and she said that the priority would be, they would not do acquisitions anymore. They would buy back stock, etc., and focus on improving the business. And the stock was very cheap. After COVID, it was pretty cheap, and so we said, okay, this looks like an attractive opportunity. So we based it on our faith that things would, that the asset allocation would be okay. And for a while it was okay, and the stock was moving higher. But then they did two acquisitions shortly after each other, which were a complete waste of money. I think they wasted maybe at least half of the purchase price. Again, increased the debt, stop buying back shares, etc., etc. The acquisitions, the market didn't like them. The stock started going down, and we just realized that if a company has a history of poor asset allocation, the only fact that the CEO changes, especially when she comes from within the company, is not sufficient. We just sold it. Because there's no point of owning a company that is doing reasonably good, but that then time to time they destroy the value by paying too much for large acquisitions. So that was a mistake. And I talk about base case and versus case rates, about in general themes in this case. So we knew that expensive acquisitions is the red flag that we want to avoid, but we tended to overweight the best case, the case rate, like believing that things in this case would turn out to be better, but that was a mistake. And in the case of Microsoft, this is a mistake as a stock we should never have sold. And we bought it in 2010, I think, or 11. The stock was extremely unpopular. I mean, it's hard to imagine today when, it's one of the Mac 7. But back then, people thought that Microsoft is a business of the past, that have nothing to do, nothing to say for the future. It traded at 10 times earnings. I mean, we had different opinion of the company. We bought it, and we had to explain to our investors for 2 years maybe why we bought stock that everyone knows is in a way out of business slowly. But then it started to go up, and we didn't have to explain it anymore. But the thing was that it started to do much better than everyone thought, and and our mistake was when we paid 10 times earnings for unloved stock, and that was like our anchor price, okay, or anchor valuation. And the earnings started to go higher, multiples started to go higher, and after several years, we just felt, it's expensive because, we bought it at 10 times earnings now, because it's several times higher, but these multiples are really expensive, so we sold the stock. And of course, we made a lot of money, but of course the stock went up much higher after that. And although on CVS we maybe lost 0.5% of the fund, so almost inconsequential because we bought it in the beginning at very cheaply. And doesn't really bother us that much. It's a good lesson, but doesn't really matter. In Microsoft, we made a lot of money, but we left so much money on the table by selling it too early that I'm still kind of bothered about this. So we try to be more general about letting the good stories run, because usually when you have something that is working very well, just let it go for a while more, because the good companies, if they are on a run, they tend to go for longer than people think. Also, the market awards them with bigger multiples, although this is a sensitive theme, because you don't want to get caught in the growth trap. Sometimes you just let it go. But it was a mistake that no one forced upon us. We decided to sell.
What is a growth trap in your mind?
In growth trap, well, people talk about value traps a lot. So value trap is a situation where you find a cheap stock, the value opportunity, but then over time you realize that the value in the business is not as high as you thought. It may be lower, it may be going down, and the stock keeps going down with it. So it keeps being cheap relative to value, but because the value keeps going down, you're basically trapped, and at the end you might sell the stock still at a discount, but you know that the discount is not really there because the value is questionable. But there's a mirror situation which I call a growth trap, where you pay too much for too high potential future growth, and then you realize that the growth won't be there, and you overpay it, and the stock collapses dramatically. And while in value traps, it's like a continuous process, and it just matters of how fast you come to realization that it's this case. In the growth traps, it tends to happen very fast, and we're actually living one case right now in a Danish company called Novo Nordisk. A year ago, the stock was above 1,000 because everyone was extremely bullish about the potential of the obesity drugs. But then, of course, the realization came that the growth might be there, but much smaller, and the stock is now 70% lower, which is very unusual for a very well-known, a large company like that. But this is probably a typical case of a growth trap. A lot of people got trapped in their expectation of potential growth, and the stock was trading at 50 times earnings, I think, at its peak, which is a lot, even if you are growing fast, and now it's priced at 12 times earnings of next 12 months, which much slower growth expectations. So the future will tell what the case is today, whether this is a value trap, value opportunity. It's certainly not a growth trap anymore.
Yeah, I think it's just very tricky, and that's where judgment comes in on this issue of selling too early a company like Microsoft. It certainly hurts a lot. But as you say, some companies turn into growth traps. So, for Novo shareholders, it would have been smart to sell at some point, maybe even a little bit early, but I think that's where valuation does need to come in, although we as value investors often underestimate how high valuation can go on those growing companies.
Yeah, it can, but it's always so. When we were buying Microsoft at 10 times earnings, you could say at that time that it's a great opportunity because it's really strong, established company, and its growth after that was much faster than people expected. But now you're paying high 30s multiple for stock like that. Can it grow fast enough to justify this? I don't know. A lot of market thinks it can, but I'm much more comfortable. It's not growing that fast, It's not like it's a decent growth, but it's not super high growth, So you can find companies that are growing at least that fast at a much lower multiples. But I wouldn't expect 15 years ago that the stock would go to 35, 37 times earnings. Of course, no one did. I mean, otherwise the stock wouldn't trade at 10 times earnings. So it's easy exposed. Exposed is always, everything is easy to explain and justify, but we don't really know whether the multiples for Microsoft today or Novo Nordisk are too high or too low or just about okay. But that's the good thing about investing, that you can never arrive at a situation where you would say, now I know this is the way it's going to be. It's always assumption, estimates, uncertainty, incomplete information, dynamic environment where things changing. So it's very stimulating.
So if you're to synthesize it all, what's your advice for finding hidden investment treasures in today's market?
Oh, I'm not very good in making bold statements, but I try to explain in the book that two things, that the environment for active investors today is very favorable if you understand it and if you approach it in the right way. And secondly, that there are opportunities out there, there's plenty of them. Although the US market may be at its all-time high now, and it's maybe one of the highest valuation levels in history. It's partially held up by the handful of top stocks. So if you go below the surface of the market, you can see a lot of opportunities everywhere in other countries, in emerging markets, in other developed markets. So I think you can have a lot of fun, and you can make a lot of money if you do the work. It's not it requires a lot of effort. That's true, and those opportunities will not present themselves every morning, but they're there.
And maybe, Daniel, this has been great, by the way. As we finish up, what are maybe some lasting principles that you want readers to take from your book?
Well, I think, as we said in the beginning, some things change, but some things don't change. And I think something that doesn't change, and I think will not change in the future, is that you should look at investments as a transaction where you exchange the money for some value, and you have to always think in terms of price and value, and always try to make investments where the price is much lower than the value. It doesn't apply only for stocks, it applies for any type of investments. And I think a lot of people don't think about these terms at all. And I think if you have the discipline and select investments in this way, then you can have actually much better combination of return and risk than the market itself offers today.
Yeah, people seem to know price versus value intuitively in the rest of their lives, but not in the stock market for some reason, which is interesting.
You go shopping, you do regular shopping. You wouldn't pay exorbitant price for something that is ordinary or good. You're always price conscious, but some people, when they look at stocks, they forget about it completely. Yeah, that's a mistake.
Well, thank you for the conversation, Daniel. It's been terrific, and thank you for writing the book. I think it's really going to be a great value add to a lot of our members, a lot of investors that want to both learn about investing as well as find potentially rewarding ideas.
Well, I thank you for doing the interview, and I also thank you for reading the book and writing a beautiful and very long forward.
It was my pleasure.
It was always my pleasure, and I'm looking forward for the moment when the book is out.
Likewise. Thank you so much.
Yeah, thank you.